Hi, my name is Dave Kuhn. I'm a certified financial planner and mortgage loan advisor with over 20 plus years of experience in the mortgage industry. Today, we're going to talk about interest rates. So, in our whiteboard here, we've got an example, a hypothetical example about interest rates. And today we're going to just assume interest rates range from 8% down to 3%. So on any given day, interest rates come out for a particular loan or particular product, and they're always going to come out in a range, right? So today's hypothetical range is between 3 and 8%. We don't want to give specific examples, right, for this case here. Now, what you're going to notice right about in the middle, and depending on the market at that point in time, is what we have what's called the par rate. A par rate does not cost you the consumer, does not cost you, the borrower, anything to obtain. Does not cost any additional rate. So basically the lender is saying, we're happy getting 6% on that loan for the course of the term of the loan. Let's assume a hypothetical 30-year fixed loan at this point in time. Anything above that par rate is what are called rebated rates, meaning anything above par, the lender is going to get additional interest income over the life of the loan, and so therefore they're going to rebate some of that cost back to you to apply towards closing costs, etc. Anything below that par rate are what are called discount rates, and these are what are commonly known as points, discount points. So in today's hypothetical example, we're going to assume par rate is at 6%. Discounted rate is at 5%. Let's assume that costs 1 point. And at 7%, we have what are called rebated rates. And let's say we're going to rebate 1 point as well back to the borrower. Okay, so when we're talking about the cost of the discount points, that one is 1% of the loan amount. In this case, if we have a hypothetical $300,000 loan, it would be 1 point is 1% of the loan amount, or $3,000. So there would be a cost to obtain that 5% rate of approximately $3,000 on a $300,000 loan. If instead you chose a 7% rate, well, there would be a rebate of 1% in our hypothetical example here. 1% of a $300,000 loan, there'd be a rebate coming back to you to apply towards costs of about $3,000. And again, the par rate being 0 does not cost you anything. You get that 6% loan for the life of the loan. Okay, so we just got done talking about par rate, rebated rates, and discounted rates. Let's take a look at how this works as a real example. Let's assume we have a $300,000 loan. And again, we went over this a minute ago. A rebate of 1%, hypothetically on that 7% rate that we were talking about, would get the borrower back $3,000 to be applied towards overall closing costs. This would be helpful if you're really limited in the amount of cash to close that you have to close the entire transaction. And if that word is of Greek or a little bit of a mortgagese to you, please check out my other video titled Mortgage 101 for the term cash to close. But $3,000 would be a rebate off that 7% rate. A par rate and would have a monthly payment of $1995.91. That's principal and interest alone for a $300,000 loan at 7%. At 6%, you can see, this is a par rate, so it would not cost anything to obtain that rate today, and you'd have a monthly payment on a $300,000 loan of $1798.65. And by buying down the rate, by paying the additional $3,000, those discount points, that 1%, you'd be paying an additional $3,000 in your total cash to close. You'd be able to bring that total monthly principal and interest payment down to $1610.46. This is the difference between rebated rates, par rates, and discounted rates. Now, when we're looking at, does it make sense to take a rebated rate, a par rate, or a discounted rate? In that same example, if we're looking at the $300,000 loan, this is total interest paid over the life of the loan, and let's assume a 30-year fixed mortgage. Total interest paid at that rebated rate is $418,523 versus par rate $347,515 versus discounted rate $279,770. Now remember, we paid in this case $3,000, right, to get that discounted rate, but it saved quite a bit of difference in interest over the life of the loan. And then, of course, this is for a hypothetical example only. we need to examine your unique situation for your particular loan. But you can see by paying the discount point, you save quite a bit of interest over the life of the loan. And really the only true reason to take a rebated rate is if you, again, need help with the total cash to close. Otherwise, you're going to be spending a lot more in interest over the life of the loan for that rebated rate. Okay, so in this last segment, we're going to take a look again at the principal and interest payments for the different types of loans. We've got the highest principal and interest payment at 7% loan. That's the rebated loan. $1,798.65 for the 6% and $1,610.46. What I really want to compare here now is between the par rate and the discounted rate. The discounted paying that 1 point or $3,000 to get that 5% rate. If we compare these two, you are, by paying an extra $3,000, you are saving $188.19 between these two mortgage payments. Each month you're saving $118.19. Quick math to kind of determine whether or not this is worth your while is by taking that $3,000 cost, right, and dividing it by $188.19, which gives you approximately 16 months. After 16 months, you would have saved your $3,000. So if you're going to live in the house for longer than 16 months, very well might make sense to make that discounted or buy that rate down and have that lower monthly payment for the life of your loan. So this has been a very simplistic example of interest rates and how they work with regard to mortgage financing. Hopefully this gives you a little bit of insight into that overall process and ideas as to what you might want to consider when talking about a rate. Oftentimes people call me and they say, Dave, what's your rate? Well, this is one of the reasons why I can't necessarily answer that right off the bat. There's many things that go into interest rates depending on your overall situation. So consult with a financial advisor. Please give me a call and we'll go over this specifically for your situation when you're ready for your next mortgage.